There's so much going on in markets, isn't there? Tariffs, trade wars, there's a lot of fear. But today I want to talk about the facts and take a Warren Buffett approach to investing, particularly with the Aussie share market in mind. Now, we know that markets have always recovered from a market crash. So today we want to cover what you need to know and if you should potentially look at buying the dip. My name's Jessica Amir. I'm a market strategist with Mumu. It's great to have your company for the weekly this March the 21st, 2025. So where do we start? Well, why don't we start with the question, do you buy the dip? That is what a lot of investors are asking us now. So let's take a look at the chart. Here's the chart of the Aussie share market over the past 1 year. We know this year the Aussie share market recently back in Feb hit a brand new record, all-time high, but then it tumbled down 10%. But it's paving a path of a recovery, and we can see that on the far right. The Aussie share market is now up about 2% off its low, off its 2025 low, that is. So what's a bullish case to support the market moving higher? Well, there's a couple key things. Firstly, interest rate cuts. Secondly, company earnings growth. Both of these things drive the share market over the longer term. So let's pause on rate cuts. The RBA cut rates back in Feb. It seems that many people have completely forgotten about that, by the way. Now, remember the facts. We're pointing that out on the right-hand side of the screen. The Aussie share market does pretty well. In the 12 months after the first RBA rate cut of the cycle, on average, the Aussie share market has risen, let's round, about 13% on average. For those who like to be sticklers, I know there's some of you out there, the Aussie share market has risen 12.5% on average over a 1 year period after the RBA's first rate cut of the cycle. That's what history tells us anyway. Plus, of course, remember, the Aussie share market does tend to do really well when the Fed, that's the US central bank, when they cut interest rates. Now, we know this week, a couple of days ago, the Fed said, hey, we're probably going to be in a position to cut rates another 2 times this year. So that's pretty exciting stuff. Secondly, I mentioned company earnings growth. Remember, earnings growth drives share price growth. I speak about that a lot here. Apologies if you're sick of that message, but I think it's worth remembering. Now, this is supporting share price growth. What are we looking at for this year? If you do have a look at consensus or market expectations for where company earnings growth could go this year, well, the market, if you have a look at the numbers today, the market is estimating that company earnings for the Aussie share market, top 200 companies, will grow 6.5% this year and grow 5.8% the year after. We're also expecting cash flow growth to surge. So this is supporting of the Aussie share market. The next question might be, what stocks do you look at now? Well, it's a big question. Perhaps one answer might be to look at gold stocks. Gold stocks are a standout, particularly Goldminers. They're delivering strong cash flow growth and earnings growth this year. That's because the gold price is up 16% this year. It cracked a brand new record all-time high just before recording this, and it's currently at $3,034 US an ounce. More upside is ahead. Now, remember, why is more upside ahead for gold? Well, tariff concerns are there. Secondly, global debt repayments. There's lots of concern about that. And global debt repayments just hit a new record all-time high. And these are two major reasons central banks are buying more gold, and that's pushing up the gold price. So on the right-hand side, I've put on the gold stocks that are producing the best returns on the Aussie share market. We can see West African Resources is up 58% this year. Genesis Minerals is up 52% this year. Regis Resources, Evolution Mining, they're up 40%. Look, even the world's biggest gold producer, Newmont, they are up 27% this year. The list goes on and on. But on the left-hand side of the page, I've put a gold mining ETF. Now, this is the GDX. Now, this tracks the world's biggest gold miners. For those that are tuning in on our podcast, I'm basically displaying a chart of the GDX, and it shows that this ETF is up 34% this year. So if you don't know what gold stock to pick, have a look at the gold ETF. GDX is a great example. But let's just strip it all back. For those out there on Mumu's platform saying that they need to do more analysis, why would you be expecting gold to explore more all-time highs and gold producers to explore more all-time highs? Well, the facts are pretty simple. Gold miners make more money because gold is rising in value. And as we're saying, making pretty clear, the gold price, the thinking is that will continue to march on up and push up the earnings and share price growth of some of these stocks we're pointing out. Let's just take an example. West African Resources, their revenue rose 10% last year to 725 million, and their revenue is expected to grow 9.6% in the year ahead to 722 million. It doesn't seem very exciting, but what's really exciting and what the market is really looking forward to is what we're seeing in the year after for West African Resources. The market, remember, is forward-looking. And with that in mind, I just want you to think about these numbers. West African Resources, their revenue is expected to surge 82% to $1.3 billion. So this is a small gold producer that is about to crack $1.3 billion in revenue. Now, whatever company you want to look at, just remember the basics. Earnings growth drives share price growth, and that is why gold companies will probably be strong compounding earnings growers. They're going to continue to grow their cash flow. That's for as long as the US dollar continues to fall. So we're expecting more higher highs for gold, and some of the gold producers that we've mentioned will probably continue to push to new highs. So that is something for you to consider. The third question of the day is, what about the Aussie election? What does it mean for the stock market? Well, it's a great question. I might answer it. Well, the Aussie share market generally does well under a Liberal government, regardless of who you vote for. The numbers are there to suggest that throughout history, the Liberals have produced a better return for the Aussie share market in comparison to a Labor government. But I just want to think about and pause on the stocks and sectors that will win regardless. That's probably where my interest is. So what I would encourage you to do is to think about infrastructure stocks and those in the industrial sector. They'll be winners regardless, because we do know each time the budget comes out, each time there's a new prime minister in town, infrastructure stimulus typically hits a record all-time high. And I guess there's a lot to be said about looking at the winners, who's doing well in the Aussie share market and where momentum is, because it's telling us infrastructure and the industrial stocks are going to win regardless. That's why Fletcher Building's up 17% this year. They make most of their money from selling bricks. And of course, they're making a lot of their bricks and selling them in the US, but they do make a large, a large amount of revenue from Australia as well. Other industrial stocks that are sitting pretty this year include Ventia Services. They're up 15%. Another industrial stock, another play is Monadelphous up 12, Worley's up 10. The list goes on. Brambles, Atlas Arteria. We mentioned them in our daily for those that are interested. And it's also worth noting that this sector is insulated from tariffs as well. The other point that is a contentious issue now that I want everyone to think about in the election is uranium and nuclear power. The market is actually betting that uranium power will be brought in if the Liberals win. And I think there's a lot to be said, again, about looking at the stocks that are gaining momentum and that are pushing higher. So there's a good reason why I'm mentioning these, because we have seen high levels in stocks like Boss Energy, DPLO, Paladin this week. They're all up considerably. So that's what I want you to also think about. The fourth question of the day, what if we've all got this wrong? At the outset, I said, should you buy the dip? And I said, if you take a long-term view, my answer would probably be yes. But what happens if we do buy the dip and we get it wrong? Well, I just want to bring in a scenario now that is a little bearish. What if markets do head south? So we've been speaking a lot about this looming April 2 tariff deadline. If we see Trump bring in more tariffs and then retaliatory tariffs come in, obviously that is going to upset markets. That'll be a big pain point. And then the concern is that we could relive what happened in the first tariff trade war of 2019. In the US, we know in totality, from peak to trough, markets fell about 20%. And back home, the Aussie share market from peak to trough fell 15%. So what happens if you buy the dip? Thinking about the scenario that we're putting in front of you on the screen, what happens if 2018 replays? So what happens if you did buy the dip back in 2018 when the market fell 10%? You thought that was the low, then the market rallied up about 5%, but then it fell back further again. Well, if you bought after the market or the Aussie share market, the ASX 200 fell 10% and the market fell another 5%, you might be kicking yourself. Your friends would say you're an idiot. But if you took a long-term view and if you stayed firm, you held your position with conviction, remembering that the markets have always recovered over time. If you held on for just 10 months, you would have made 26%. Basically, if you chucked in $10,000, you would have made $2,600 and you would have made in total $12,600. All I'm saying, ladies and gents, is there is a lot to be said about buying the dip. Even for those of you out there who say you can never pick the dip, if you still buy quality, we always know that quality stocks over time do recover, and that includes the Aussie share market. So hold firm, stay to your conviction and think about your strategy and invest in yourself. With that in mind, have a wonderful weekend. Thank you so much for your company. And from all of us here at Moomoo, we wish you a happy and safe weekend. Bye for now.